For another highlight from the Aspen Ideas Festival, Bloomberg's Erik Schatzker sat down with David Rubenstein, co-founder and co-chairman of the Carlyle Group. Erik asked him about President Trump's policies on trade and China.
I haven't studied every single position he's taken. Clearly, there is a lot of controversy with some of the positions he's taken. He's a negotiator by trade, and I think he feels by setting out certain positions that are tough, he can probably get a better deal in the end. So we'll see if that works. Clearly, the business community doesn't want to have confrontation on a long-term basis with our major trading allies, Europe, China, and others. So I think in the end, the business community would like to see these resolved peacefully and successfully, but I don't know where that will come out. But I wouldn't say anybody is thrilled to see confrontation. I don't think the president's thrilled to see it, but we want to get something done that will ultimately be good for the U.S. economy and good for the other economies.
So if you're right that this is a negotiating tactic as opposed to an absolute end, do you think it'll work?
Well, sometimes it can work. For example, in North Korea, President Trump was pretty tough on North Korea, and then he got a meeting with the president of North Korea. We don't know what the result will be, but the tactic may have worked. With respect to Iran, he pulled out of the agreement with Iran on nuclear, but right now Iran is still complying with the agreement, and it seems as if they're willing to make some negotiations to come closer to his position. So his tactics may work sometimes, not all the time, but we'll see.
Do you think, as a matter of principle, an approach like that is a better approach than the one previous presidents have taken, whether those presidents be Obama or W. Bush?
Time will tell. It wouldn't be the approach that I would take, but I'm not President of the United States. Nobody voted for me. So people voted for him. So he has the right to try his approach. Now, obviously, it's a system where Congress has some involvement and other people have involvement as well. But it's an approach. I don't really think that we're going to go to a long-term kind of tariff war. I expect that. I don't think that will happen. I think in the end, these things will get resolved and negotiated. But it's like Bismarck once said, two things you don't want to see being made are legislation and sausage. And he might have added trade negotiations as well. Now, trade negotiations can be complicated, and I think it's going to take some time.
In the interim, these positions are creating tension. And they're, in the case of some companies, they're creating problems. What impact do you think they'll have on the economy?
Well, if it's a long-term trade war, I don't think that would be good. Remember,
how do we define not good?
Well, right now, our economy is as good as you're going to get. The economy is growing maybe for the second quarter over 3%. Inflation is maybe 2% or lower. Unemployment is under 4%. So what more do you want? We've been in about 109 months consecutive growth, and there's no sign of it slowing down. So I think the economy is in pretty good shape for this year and next year. Now, if something unexpected could come along, that could change. Right now, if we went into a tariff war, that wouldn't be wonderful. I don't think that will happen. I think there'll be negotiations that ultimately will resolve this. At least that's my hope. In Carlyle's case, for example, we have 250 companies around the world. They operate in Europe, in China, in the United States. They wouldn't want to see a tariff war. So I think everybody would like to see these resolved, but we want to make sure that we have equitable trade agreements with people.
Do the tariffs that have been implemented or the ones that have been threatened have an impact on Carlyle's portfolio companies?
Well, at this point, with 250 companies, it's hard to say what the impact will be in the tariffs to the extent that they...
Carlyle hasn't done a workup on this?
We have done it, but it's hard to say because the impact hasn't been felt. It's relatively new. So
well,
if
look
this
at Harley Davidson, for example.
Well, we don't own that one, but...
No, I know.
But I think at some point, if these kinds of things went on for a long time, it would have some impact. At this point, it's too early to say it has an adverse impact. It doesn't have a positive impact, but I can't yet say I see a deterioration in our company's performance. But again, I would like to see a successful resolution of this, and I think the business community would in the short term rather than long term.
You have spent a considerable amount of time in China. You understand the issues from the American perspective. You understand the issues from the Chinese perspective. Let's talk about them both. How far do you suspect the administration is willing to go with its challenge to China?
I don't know, because it depends on what part of the administration is really going to take the lead. There are different people in the administration that have different responsibilities. The president obviously makes the final decision. I think it's too early to tell exactly where the administration is going to come out on tariffs and trade barriers. I suspect it'll get resolved at some point when the president meets again with Xi Jinping, and before that meeting, I suspect there'll be some resolution.
And what about the converse, the Chinese? They have a number of instruments that they can wield. For example, antitrust approval. That came up recently in the NXP Qualcomm situation. The Chinese could make a decision to stop buying U.S. Treasury bonds, either wholesale or in part. What do you think about those options or perhaps some others?
Well, let's talk about the latter one. I think it's unrealistic for China to not buy our Treasury bills. For one, it would hurt them. They own over $1 trillion of Treasury bills. If they stopped buying them, it would decrease the value of the ones they already own, for one thing. It would also have an adverse effect on their currency because it would increase the value of their currency, which is not what they probably want to do right now. So I don't think that's something they will do, and they've never threatened that. They've never said they would. When I've talked to Chinese central bankers, they've never said that's on the table. On antitrust, there's no doubt that antitrust can be used in ways to slow down acquisitions and so forth. But I should point out, right now, it's very difficult for the Chinese to make any investments in the United States. They have their investments here are modest compared to what we're investing in China. So it goes both ways. I think we have to let the Chinese invest certain things in the United States, not in strategic industries, and we have to be able to invest in their country as well.
David, if I look at Carlyle, I see a firm that is a product and a beneficiary of what we might call the post-war system of global trade and investment.
That's correct.
And you even base the firm in Washington, right? You're as close to the power structure as any in your industry. It makes me wonder whether Carlyle needs to contemplate, or at least consider, the need for a change in strategy if, in fact, the president is successful in what he appears to want to do, which is to dismantle that post-war, in part, or undermine the post-war system of trade and investment.
Well, I think what the president wants to do, and I'm not his spokesman, I can't speak for him, is to improve the system we have and to make it more equitable. If he can do something along those lines, that would be good. But we don't want to obviously ruin our relationships with our allies or impair our relationships with people like China or countries like China. And I don't know that that will happen. Right now, it's in the early stages. We'll just have to see how it goes. Currently, I think there's a lot more that has to be negotiated before anybody can be satisfied with what's going to happen. I don't really see, in the end, a long-term tariff war going on, though.
What about the investment climate? How would you describe it right now?
The investment climate is cautious because prices are very high. In our industry, prices are high, and you know, you get a little bit in the nosebleed category when you pay the kind of prices that the industry now has to pay. On the other hand, the returns have been good, and the economy's been good, so it's been possible to exit at pretty good prices. So right now, investors are reasonably happy with our returns and with the returns of our peers. I think that as long as the economy is in pretty good shape, I think that will continue. Now, at some point, the economy may not continue at this pace forever, but right now, I don't see any sign, and we don't see any sign of a slowdown or an economic recession.
It doesn't feel to you like the cycle is nearing its peak?
I thought that 4 years ago, 3 years ago, 2 years ago, 1 year ago. So right now, this cycle may be longer than anything we've seen really since 2001. We might be the longest cycle ever of economic growth, but it could go on for another year or 2 or 3. I talked to a lot of the leading economists in the country, and I can't find any of them who say, you know, we're going into recession in 2018 or 2019. They just don't see that.
Well, economists are notoriously bad at making predictions to begin with.
Yes, but the business community also doesn't see the signs. In Carlyle, we get data from all of our companies, and every quarter we look at it and say, do we see any signs of a slowdown? And we really just don't see it right now.
Some people point to the increasingly high EBITDA on private equity deals as a sign of excess. What do you think?
Who was that person that pointed that? No, they're not. I'm kidding. Of course, they're higher than they normally are. I would say for
north of 10, in cases north of 11 and 12 is high.
Yes, the EBITDA multiples have gone up. Before the Great Recession, the average EBITDA multiple was probably under 10. Probably today it's between 10 and 11. However, investors are willing to take lower rates of return than they were 3, 4, 5, 6, 7 years ago. And as a result, if you can get a net internal rate of return on average of 15%, as opposed to 18 or 19%, investors in this environment are reasonably happy. So that's why people have been paying higher prices. Investors are willing to take reasonably lower rates of return because everything else is not as attractive as private equity.
You describe the investment climate as cautious. How would you describe your own risk appetite?
Well, I am a cautious person by nature, so I wouldn't say I'm...
So on a relative basis, you've lived through a few cycles. So you've probably swung between cautious and, at the very least, less cautious in the past.
You're always tempted when markets are going up to say, I want to make sure I don't miss something. So you rush in. I try not
FOMO.
to do that. you know, you never know when the markets are going to end, and all of a sudden the music stops, as they say, and it's very difficult to find a place to sit. So I don't know that I'm a person, or Carlyle's a person that's taking out a risk. We're not really that kind of firm. We're a firm that's trying to say we know what we're doing. We've got a long history of it. We know how to invest through good and bad cycles. And right now we think the cycles are pretty good, but we're cautious. We don't think it's going to go on forever like this way.
What are you doing less of, for example, today than you would have been, say, 5 years ago?
Well, today, probably we are not putting as much debt on the deals as we were many years ago. I think the debt buyout deals have less debt percentage-wise than they did before. In the early days of buyouts, you had 5 or 10% equity and 90% debt. The famous RJR deal in 1989 was 95% debt. Today, I would say they're closer to 40% equity in many deals, some cases more than that. So the deals are much better equitized and therefore not quite as risky.
And is that a change from, say, like I say, 5 years ago?
It is. The deals are, I think, much better equitized, less debt. Also, the debt, to be honest, is very favorable. It has covenant light or maybe no covenants at all. And so I would say before the Great Recession, probably about 70% of the deals were deals that had restrictions. Now probably 70% have no restrictions in terms of covenants.